If you've got a mortgage, you might be wondering whether it's worth overpaying it instead of putting that cash into other things. Well, what I want to take you through are the pros and the cons to help you decide what's right for you. The spoiler is there's no one single answer. It will vary by your own situation, but hopefully this will give you an idea of what's going to be the best thing for you. So first of all, big pro. The number one reason why people want to overpay their mortgage is undoubtedly because of that security that it gives. If you overpay on your mortgage, as long as you choose to reduce the overall term rather than the monthly payments, that's really important. Reduce the term, it obviously means that you are going to have a mortgage for as long as you originally said you would. It means you are mortgage free, which means you have much more flexibility and freedom and security later on. So that is a big, big reason. And that is something which kind of beats probably many of the other options. But another big pro is the financial benefits of overpaying your mortgage. Because when you add money into your mortgage, whether it's a one-off lump sum or a regular monthly payment or a mix of the two, or you do it for a bit and you stop doing it for a bit, whatever it might be, not only are you reducing the entire duration you have a mortgage, when you do that, when you reduce the time you owe money for, you also reduce the amount of time that you're going to be paying interest on that balance. And not just the overall balance, but obviously each time you overpay it and bring that balance down step by step, you're paying less interest on the amount that's there right now. And that can be quite sizable. I'll give you an idea here of what that might look like. Let's say you've got a £200,000 mortgage and over 25 years, yeah, I know you might have a shorter one right now if you've already had one for a while, or if you're just starting off, you might have a longer one. But say 25 years, 200K at 5.49. Obviously, that rate can change unless you've got some ridiculously long fix or whatever it is, which don't really exist. But generally speaking, that'll change. But we'll say 5.49 just for this example. If you made a £5,000 overpayment, not only would it reduce the term by a month and a year and 3 months, it would also save you around 14 grand in interest. That is huge. That's just how much more you would have paid if you hadn't made any of that payment at all. And if instead you did a regular £200 payment for that full 25 years, every single month, an extra 200 quid on top of what you actually have to pay, it would reduce that term by 6 years and 3 months. So again, because you're putting more money in over all that time, but also about 47 grand would be saved in interest, which is absolutely massive amount of money to be saving. Oh, it's a long time, 25 years. That is a long period to be doing this every time. And we'll come back to how it compares versus savings in a moment. But that is, a really, really good pro of overpaying your mortgage, reducing how much you can pay. Now, I mentioned there as well that that example rate I gave you at 5.49, whatever the rate is you've got right now, it's very unlikely you're going to be stuck with that, sticking with that at least for the duration of your mortgage. You are at some point going to have to remortgage, or if you don't remortgage, hopefully for a better deal or best deal out there, you'll move on to a standard variable rate mortgage, and they're often some of the most expensive ones out there. So there is another benefit of overpaying your mortgage for when it comes to remortgaging. And that's because you remember this when you first got the house, or if you've already mortgaged already, the way the deals are advertised, the mortgage deals are advertised, is generally as a percentage. Yeah, so maybe it's a 95% or an 80% or a 60% mortgage. And that is basically the 95, the 60, whatever it is, that's how much money you are borrowing versus how much you already have. So in 95% mortgages, you are borrowing 95% from the bank or building society, whatever it might be, because you have a 5% deposit or 5% equity in the property, you've had it for a while. Now that's something called loan to value. And this is really, really important because the more money over the years that you put into the mortgage, not just from your regular payments, but the overpayments on top. So both of those combined will be bringing down the potentially that percentage, that ratio between what you owe and what you already have. You're building up that equity all the time. Well, that means you've got access. The lower that LTV goes, the access you've got to better deals, because often the cheapest ones, the lowest rates, are going to be for people who have got more equity. Generally, that doesn't go below an LTV of 60%. But if you've got 40% equity or 40% deposit, and you can, via your monthly payments and your overpayments, and you get it to that stage there, you can get a 60% LTV deal, you're going to get some of the cheapest ones out there. So you put more money in, the faster you go down those rates. It's very important, obviously, when you remortgage, that you declare that you make sure you check what the current equity is in there, because if you could just sort of remortgage your existing thing, it might not make a difference. You've got to remember you've put more money in. And what's good about when you do overpay, it helps you get to those thresholds faster. And there could be a situation where you can, just get that little bit, you're just a tiny bit off, but overpaying can bring you back down past that, and again save you, because you're paying lower interest rates longer term, saving you even more money. Obviously, if you combine that by continuing to overpay on your mortgage after that as well, again, it clears it. The lower rate, the less interest, all these things together means reduces, gets you mortgage free faster, and reduces how much that you will pay in total. So lots of really good pros from overpaying your mortgage. There are some other things you have to consider, potentially cons, not always cons, they might not affect everyone, and they might not always be a bad thing, some of these options. But the first one to talk about here is whether actually it's the best use of your spare cash. You've got to be thinking about, first of all, do you have an emergency fund for emergencies, anything that might come along? If you've put that money into your mortgage, then it's not going to be available if the boiler breaks, or if the car fails the MOT or something like that. Or likewise, anything else that you're saving for, big or small, it's better to have it available to you than to later borrow elsewhere in a different way in order to get those things. So certainly you want to make sure you've got an emergency fund set up, and you want to make sure that you've got savings available for anything else that you want to spend. You know the drill, right? Those things all kind of lined up. That probably makes a better sense doing that than overpaying your mortgage. And perhaps even a step before that, if you've got any expensive debts, any other debts, generally they're going to be way more expensive than your mortgage. Credit cards, loans, anything like that, you're better off clearing those first of all as well. Because again, you're overpaying the mortgage and you're saving money on interest there. But if you're getting charge loads on the other hand, from that credit card, from that loan, whatever it is, well, again, that's not good. It's not going to balance out. So clear those other debts first of all. So yeah, overpaying your mortgage is not going to be the best thing if those things aren't already sorted. Then we get to the next level though. And again, overpaying here, it will depend. And this is about savings, because sometimes overpaying on your mortgage is going to be better than putting money into your savings on a mathematical level. Again, assuming that you've already put that cash into that emergency pot and so on. But other times it's going to be the other way around. So sometimes it's going to be better off to have it in a savings account. And really it comes down to the rate. Now, where we are right now, we are obviously seeing, after a couple of years of interest rates going up, the base rate going up, which has pushed up mortgage rates and pushed up savings rates, both of them going up, they're now starting to come down. But the rates on savings are coming down faster than they are on mortgages broadly. Not every time, not in every case, but broadly they are. But that might depend on when your situation is right now. When did you get your mortgage? If you got a 10-year fix 6 years ago, before all this mess happened, well, you've still got another 4 years at potentially a very, very low rate on your mortgage, which would probably be very easy to beat in savings accounts, even if they are off that peak that we saw in kind of late 2023 and sort of early 2024. So in that case, you save. But also there are still, despite falling savings rates, there are still some savings accounts out there which pay really, really high rates, higher than probably most mortgages out there, even those standard variable rate ones. This is probably like a regular saver. Now, there are restrictions that come with many of these regular savers, but if you can get above 6%, potentially, some of these accounts, 8%, even one of 10% recently, I know that you can only put a small amount of money into them every month, but that's the same as overpaying. You're probably only putting a small amount, let's say anywhere between 50 and 400 quid, generally how those regular savers work. That's probably a similar amount that you'd be if you were regularly overpaying in that range anyway. That's still going to be way, way better. So again, no clear cut here. It might be better for you to overpay the mortgage. It might be better for you to overpay the savings. You need to look at what the difference is between those two rates. But there is something else you do need to factor in here, which might make overpaying the mortgage more of a pro than a con versus savings. And that is around tax on interest on savings. Most of us will have something called a personal savings allowance, which is a tax-free amount we can earn every year. Basic rate taxpayers, that is £1,000. High rate taxpayers, it's £500 of interest every year. If you're an additional rate taxpayer, it doesn't exist at all. And then you'll be paying tax on your returns above that. Now that, if you have got a lot of money saved away and you're getting a still relatively decent interest rate comparatively to recent years at least, that will reduce your effective savings rate. It will drop, to say you're paying 20% tax on your interest, you get a 5% account, but you're paying 20% tax on anything over £1,000, it obviously brings it down to 4%. And then you've got to compare, really that rate is what you've got to compare with your mortgage rate. And if you're an additional rate taxpayer, obviously then you're going to be paying 45% tax, which is massive on all the interest you earn, which really, really will cut it down. Now, obviously you can have tax-free savings accounts as well, such as ISAs, such as premium bonds. So all those things do go into the mix to help you work out the best option for you, the best possible rate out there. But you do need to think about these things, because obviously any money that you overpay on your mortgage, you'll be saving on interest there. but you won't be taxed on that. That amount you save is exactly what you'll save. So that's something definitely worth considering. And of course, it's not just savings you could be doing with your money instead of overpaying your mortgage. There's investments as well. And I know we don't talk about investing very often, but it's certainly something to be thinking about for the longer term. And in fact, the long-term investments that we all have pretty much are our pensions. And it could be putting money into those instead, pensions or a normal investment or stocks and shares, ISA, whatever it might be, will give you larger returns in the long run compared to that just saving on the interest on your mortgage. There's always a risk associated with that, and you want to say at least a 5-year timeline to ride out any potential sort of ups and downs in the market. So do your research on that if you're not particularly, haven't done much of this already investing. But again, that is something else you might want to consider instead of. And also, when it comes to pensions, don't forget that employers will match contributions up to a certain amount. So if you can put more into your pension and get more free money from your employer as a result, then that's a win. Plus also you get tax relief from the government. And again, if you're a higher or additional rate taxpayer, you get even more tax relief on top of the one that everyone else gets, the basic 20% that everyone gets. So again, they could be much more valuable as well. I think ultimately, you might want to do a mix of those because pros that we spoke about at the top there for overpaying your mortgage, they are still very true, particularly that kind of peace of mind and that security it gives you later on. So you may well want to put some into your mortgage, some into savings, some into your pensions, some into investments and sort of level the field there a little bit. But obviously how you want to do that is up to you. There's another con that is worth sharing with you quickly about overpaying your mortgage. And that is you might be limited in how much you overpay. And if you exceed that, you could get hit by a charge, which could be very expensive. Now, broadly speaking, most mortgages will limit you to 10%. And you have a look at this every year, 10% of the mortgage, the total that you took the mortgage out for, that's how much you can pay every year. Generally, it won't reduce year by year. As the mortgage decreases, it's at 10% of that original amount every year. And that's fine, that's within the terms. There are some generally variable rate ones, some tracker ones, but some fixes as well. Does depend by provider and often depends as well when you took it out and the product available at the time. So you can't give you a hard and fast rule here. But some of them don't have a cap at all, or they might have a cap somewhere between that 10% and the whole amount. So you've got to make sure you stick within any cap there is, because if you do pay more than that, or pay off the entire mortgage early, there could be an early repayment charge on this. And that could be quite a lot. It could be a whole percentage of the whole balance, the original balance, or it could be what was left. But you really need to pay attention to that and check what your mortgage says. And if you are capped at 10%, generally speaking, it's not going to be good to go over that. And that's when you want to think about, again, putting that additional cash, if you have additional cash, to use elsewhere. So there you go. Pros and cons of overpaying your mortgage. See what situation works for you. Check some of those things, such as the rate you're paying on your mortgage now and the rates available for you in your savings elsewhere. Check to see if you can get more free cash from your employer or whether you can claim tax relief on pension contributions as well there. Have a look as well to see if there are those early repayment charges or those caps on how much you can overpay. And once you've got all that information together, you can make a decision on what you do with your spare money. My name's Andy Webb. Thank you so much for watching this. Check out these videos for more ways to make the most of your money.